did you make of these numbers?
Look, we're quite happy. Let's have a look at the backdrop. Qantas has been a big underperformer for our various portfolios since December. So the price migration down. So these results have come out, and let's break and have a quick look at the results. The quality, we believe, is quite good. For example, there's some good earnings numbers coming through from the low-budget carrier called Jetstar. On the freight side, that's a good positive there. Also, the underlying earnings coming through from just the core long haul as well. But importantly, they've been talking about cost reductions. They've delivered cost reductions, and these come through in the numbers as well. So a combination of delivering on target with some good cost reductions, as management have said, plus the underperformance since December is leading to that good performance today. So we are quite happy with this core quality cyclical in our various portfolios rebounding on the day.
Yeah, that's right. Qantas, though, has been the underperformer amongst global airline shares. So what about right now? You're calling Qantas a buy?
Yeah, Qantas is very much a buy. We specifically have a price target above $3 or one year forward about $3.30. But we like core quality industrial earnings momentum in Australia for calendar 2011. Qantas, just like Asiana and Boubouras and some other similar companies. But the point is we need core quality industrial earnings momentum is picking up. Qantas is one of those vehicles for us. They've had some headwinds, of course, that are well publicised in the last 2 months. But I think it's delivering on the day.
Okay, yeah, looks like right now we have Qantas higher by over 5%. But what about the risk of higher oil prices right now? Is Qantas doing the right thing in terms of what it's doing with hedging?
Yeah, that's always a risk going forward. And higher energy prices, it's a real big impact on this airline going forward. That is true. So they have their hedging strategies. But look, management have dealt with this in the past, and they've got that long-haul growth, which is obviously very much impacted with the energy prices. But we believe that they'll be delivering consistently throughout calendar 11. And we just believe that sell-off has really reached a bottom. It's gone too hard, too quick, and this is a positive turnaround. And the market looks a little bit short, and it's just trying to catch up on some core industrial exposures, and this is one of those.
Okay, I want to talk to you quickly about the ASX. You have a neutral rating on the stock exchange. It seems that investors are focusing more on the press conference and what they're going to say about the SGX tie-up than what they actually reported in numbers.
Look, that's correct. First and foremost, ASX core quality, delivery of their earnings, as they always do. It's always very clean. They're very good executors of what they do. But the market's obviously looking at the Singapore Exchange, ASX. From our perspective, it's always in our portfolios as a good quality, diversified financial. But we all know these exchanges, they need to grow. It's all about market share, and they need to grow because the derivative businesses have to be diversified from their revenues, not from one market. They need it from multiple geographic markets, and that's well played out. So we will be waiting like everyone else to see how that develops. But they're good executors. The derivative business is good. Their fixed income business is good. The equity business is good. But just to compete and continue to develop, because technology is a big part of this space, they need to become more important on the regional perspective and on a global perspective. So that's what the market will be watching, I think, going forward. But they're very good executors, and they have delivered again.
Okay, George, let me talk to you about the broader market itself, because your 2011 year-end forecast for the ASX 200 index is pricing an upside to 5,600. That's pretty optimistic. Which sectors do you think will lead these gains?
Yeah, the core sectors, obviously mining services. So you got BHP, Rio, and the petroleum like Woodside, the re-rating of the large ones and Worley Parsons. But also the banks and the Aussie banks, we believe, will be delivering their high dividend plus some capital gain between 5%, 7% or 8%, depending which bank. But there's margin expansion potential with the big four banks, with credit growth picking up, is our expectation as the year develops. So the big four banks in Australia, while they have their funding...
there about the banks. Yeah, because Moody's right now is looking to downgrade these bank shares. That hasn't changed your view right now on the lenders?
Not at all. I would say that Moody's will probably a year late in bringing these issues up. For example, it's a well-known and documented that the Aussie banks, the big four, a little bit oligopolistic in pricing power, but they need wholesale term funding offshore, and we know that's very expensive. It's much cheaper than 2008, 2009, but versus the long-run average, it's obviously more expensive. So we know that a 5-year CDS of the big four banks is 105 to 110 over versus where it was in June last year, 150 or 250 plus in the GFC. The point is the regulators are really addressing a few of these things. And firstly, there is going to be covered bonds as a solution for the Aussie banks. That's a tick. That's a diversified funding strategy. They have got a high quality grade of earnings versus their offshore peers, and that's well documented. The macro environment has been very strong, and they've been growing their business into that wealth management space. ANZ in Asia, diversify, and the others obviously in Australia. And wealth management is the fastest growing segment in financial services globally. So they have got great strategies, and they have got some good consistent earnings numbers. So we do like that backdrop, and we do like the dividend and the certainty of that dividend.
All right.